right. Welcome, Jess Brady, Financially Fierce podcast. You're joining me today on the show, so welcome back.
Thanks. It's nice to be in your new fancy studio.
I know, it's great, isn't it?
Yeah, it is great.
Jess has a podcast, Financially Fierce. We produce it for her. I've got no say over the content. She does it all. So if you love it, give her credit. If you hate it, give her the discredit. But yeah, we just wanted to provide more options for listeners, and lots of you listen to the Financially Fierce podcast.
Yeah, and thank you. And we've just turned 1.
Ooh.
Yeah.
Wild.
I know, wild. It's been great.
Yeah. Hey, I haven't talked about this for a while. People love my rants when I talk about the chess versus non-chess debate. There is a question here, also anonymous. Chess versus custodian for tax reporting. Hi all. Looking to DCA, that's dollar cost average, into a couple of ETFs long term with potential small sells here and there. Why are we doing potential small sells here and there? Anyway, I'm wondering which model, chess or custodian, would be the simplest when it comes to tax report. Custodian, next question. Let's move on. I've bought a few individual stocks, chess sponsored, in the past and always dreaded tax time having to deal with buy-sell reconciliation, especially when making multiple buy-sells of the same stock through DCAing and offloading. I believe both chess and custodian models have different reporting methods, and I'm wondering if one is simpler than the other. Any insight and recommendation would be appreciated. Cheers. Do you want to go first on your views on this, or do you want me to keep on this rampage?
Oh, I like you on a rant. Go on a rant and then I'll add my bits.
Okay. Children, gather around. You've got to understand, number one, this question has said there's different reporting methods. When you've got a broker account, in theory, there's no quote-unquote reporting. You get a statement or whatever on this many shares, this company. If you sell, off, blah, blah, blah. I'll step back for those new at home. CHESS is the ASX clearing house electronic subscriber system. Probably got that wrong, but sub-register system, whatever it is.
Yeah.
That's annoying me.
Are you going to talk about HINs?
Yeah, I will, but I just had a total mind blank.
Oh, you could have said anything and I would have gone, yeah, it sounds about right.
Yeah, I think I was right, yeah. Clearinghouse electronic sub-register system, whatever. So basically that's the register on the ASX of what parcels of shares have been traded and where those shares are sitting. Each person who buys shares or each entity has what they call a HIN, holder identification number, and effectively if I open a new brokerage account, that broker is what they call my CHESS sponsor. So if I log into CommSec, buy 300 CBA shares, it will say HIN, Glenn James, this number, CBA shares there. So the custodian is when you have, they call it an omnibus HIN, a company, custodian, if you will, has one HIN that they use for lots of different investors.
All the people on the bus.
All the people on the bus. So the purest argument is I only buy ETFs and shares that are CHESS sponsored because if something goes down, I've got the HIN, I own the shares. Okay, that's cute.
And true.
And true. However, brokerage accounts do not really provide reporting. So if you had a CommSec, NabTrade, Selfwealth, Perla, any CMC, any brokerages that are CHESS sponsored, you'd have to plug in some type of tool, if you want, you don't have to, like ShareSite, that tracks the date or the day, the amount of shares and the share price for purchases and sales and how many parcels of shares in each transaction. So in 3, 4, 5, 7 years' time, 30 years' time, you can say, okay, we bought this parcel of shares back in 1992. This is the tax, the growth. You've got to do that reporting.
Yeah, because you don't want to do that manually.
When dividends are paid or distributions from ETFs, you've got to track that as well for your own tax reporting. Whether you use like a share site, whether you use your own spreadsheet, whether you at the end of the year give all the documents to an accountant or if it's fed through the ATO, there you go, you work it out. So a lot of purists think that I only use CHESS sponsored because it's the only way to go. I think if you are that pure, you might not understand the reality of the world that we live in. If you're a purist that only does CHESS sponsored ETFs, well, you don't actually own the underlying shares anyway. The company that you bought the ETF through own the shares. So yeah, purist, you own the units in the ETF. Awesome, that's cute. The minute you want to buy any shares through CommSec, NabTrade, SelfWealth that are not in Australia, you're exiting the CHESS system anyway, and you're going back to custody. So
Custodial, yeah.
yeah. So basically, I don't care what anyone does. I'm sleeping just as well tonight. But if you're going to be that pure, you need to run that standard in your whole life. Most people that invest outside of super in their own name that are purists with CHESS, guess what? Most of you would have more super than the money outside of super that's pure on CHESS, and all your super's on custody with a superannuation super trustee. So what are you doing? Now, full disclosure, I don't have any of my equities direct through a CHESS sponsor.
Really?
No, why would I?
Okay.
I don't know,
I have a mix.
Yeah.
I have a mix.
Yeah.
Yeah.
So, okay. So the reason I don't is because I want tax reporting sorted out. Now, there are 100%, some legitimate reasons, like you might have a self-managed super fund and you've got direct equity portfolio only, no ETFs. Sure, go get a CHESS sponsor, do it. But I just think you need to understand, and everyone out there in Reddit and Facebook land and all that stuff, when someone politely asks, hey, what broker should I invest in? They're just so dogged with this, you got to get a CHESS broker, you got to get a CHESS broker, and just confusing people.
Are you on Reddit? You have to stay away from Reddit. I can feel
That's
the
fun.
anger. I think there's also a piece here around just the efficiencies that you can get from a cost perspective when you are doing the custodians. So I think that there are pros and cons depending on what's important to you and what you want. Like there's no one perfect answer, which people get really frustrated at because it's like, well, what's important to you? What are you really looking for?
Well, there's a perfect answer. Understand what you're doing and then do it and tell Glenn to shut up because you've got your reason and you understand it.
Totally. But you just got to figure out what that reason is
Yeah.
because that'll lend you to
Yeah.
the option that's going to work best for you. It's just hard when you don't know what is the priority in terms of owning that directly or maybe it's that actually fees are really important and being able to aggregate those and have fractional options and, all that sort of stuff, that becomes a priority.
And that's what I would say. If you're one of these CHESS zealots and you've got a SelfWealth account, Perla account, NabTrade account or CommSec account and you're a CHESS zealot and you've got ETFs on ASX and you've got direct equities in the US, but probably are because don't be a zealot because you're actually doing the opposite of your zealotness. Someone sent me an Instagram message the other day, Vince.
Did they?
And they said, do you have an episode on listed investment trusts or LICs? Do you know what I said? No?
No, but I'll get that idiot Vince up and we'll talk about it.
I'll get Vince up and he can explain it. So, I mean, high level listed investment companies, and I've got a bit of a presentation for those who are watching on YouTube, but you won't have to if you're in the car listening. High level, if someone is new to the investing world and they've not heard the phrase LIC, L-I-C, what is a LIC? What's a LIC?
A LIC is what the label says, that it's a company that invests and is listed.
Right.
Now, what does that mean? Well, it's a company that you can buy its shares on the stock exchange.
So it's a public company?
It's a publicly listed company. Some of them are very big. And all it does is invest in other shares.
Right.
So it's a pooled portfolio of shares, which saves you trying to pick 20, 50, 100 shares to get your balanced or diversified portfolio.
So the listed investment companies in Australia, and there are only a handful of them.
There's a handful of material ones. There's 87 all up, by the way.
Gosh, yeah. But I mean, it's effectively a listed, active managed fund.
Yeah, absolutely. Yeah, that's a really good way of describing it. And it came about to solve a problem back in the 1920s and 30s, although they weren't actually listed back in the 20s or 30s. It was a way of letting individuals get a broad portfolio without having to go and buy 20, 50 shares. And they went to their stockbroker and they bought a share in the relevant company. They started being listed in the 60s, and it suffers from a few problems, and we'll probably come on to this, but which ETFs have largely solved.
Yeah.
The problem was that it was great for the fund manager because it was a fixed pool of capital, so they didn't have to worry about redemptions. It was tradable, so customers loved it. It paid commission, so stockbrokers loved it. And the downside was that when you wanted to sell it, you had to find someone else to buy your shares. And so the demand for the shares drove the price you got for them, not necessarily the value of the underlying portfolio. Then in the 50s or so in Australia, we got managed funds, which made sure that you could buy and sell at precisely what the underlying shares were worth, but they weren't listed. And the manager had to deal with redemption. So when you wanted your money back, they had to go and sell some shares to give you your money back. And then in the 80s or 90s, we got a best of both worlds, being the ETF, which allowed you to trade at the value of the underlying assets. You could buy them online.
The liquidity wasn't a problem.
And liquidity wasn't a problem. And the capital gains tax problem of people coming in and going out went away. So the ETF has largely superseded the technology of a LIC. It's probably a better tool. The LIC is a better tool for active portfolios. So if you want active, the LIC is probably a better structure than the ETF. And that's largely around disclosure. So LICs don't have to disclose their holdings every day.
Yeah.
And so it's hard to take, if you're running an ETF, it's hard to take a really active position because everyone can see what you're doing.
Yeah. I'll just start by, in the presentation we're going to step through, and you can see this if you are watching. We're going to talk about basically in some comparisons two of the main big LICs in Australia, Argo, the ticker is ARG, AFIC, the ticker is AFI. And then I've just kind of put a comparison of IOZ, which is the ASX 200 BlackRock Index ETF. A couple of things here. Argo started in 1946, AFIC 1936, and IOZ, that ETF was 2010, but the index has been around for as long as the ASX has been around effectively.
Except it wasn't called the ASX 200 in those days.
No, was the ASX,
Ordinaries.
the All Ordinaries, which was what, 30? No.
1800 at one point.
Yeah, really?
But it's been around since, as long as
the All Ords are 30 shares. Or am I?
That's the Dow.
The Dow. Oh, all right. We're going to...
Close but no cigar.
It's this is why you don't record with me before 11 a.m., Vince. But this episode, you know what, Vince? Today it is brought to you. You don't know this yet, but it is brought to you by Life Sherpa Invest. So I disclose I invest with Life Sherpa Invest. And it's effectively your company's portfolios that you use for your advice clients, but people can rock up with, start at $5,000 and put in, and they get the benefits of your IP, your portfolios, and set and forget, keep pumping money, select their risk profile. It's pretty good.
It is. And their portfolio is largely of ETFs with some managed funds.
So there you go. You can Google Life Sherpa Invest. Otherwise, let's get into a podcast.
Let's go. Let's podcast.
Sold some shares this year. CBA held for 25 years. DRP makes establishing a cost base a nightmare. Any advice? Good luck. Next question.
I know. It's these DRPs are really a nightmare.
Gosh.
And this, that's the whole strategy of investing for a lot of people, right? They just keep putting these DRPs in place. So technically you are supposed to keep record of all of these DRPs, whether you get 2 or 3 shares, maybe it's even just 1 share each time there's a dividend. There are some sites that can help you generate this sort of stuff. There's a platform called ShareSite, which provides you with some pretty comprehensive historical data. There is some thresholds depending on investments that you hold as to whether it's free or
I think
not.
you get 10 holdings for
Yeah,
free.
but
It doesn't help when it's 25 years down the track. It's more of a forward planning thing now, isn't it?
Exactly. But, I think when you have shares, part of that is a responsibility to make sure that you keep appropriate records.
So on that, Rowan's had CBA shares held for 25 years. I go out on a limb, there could be significant value there, okay? There could be 300 grand worth of CBA shares. We don't actually know. I'm making a number up. You basically, if Rowan rocked up to your practice and said, here we go, it's literally like, okay, well, you've got no records. We'll log into the registry and see what we can find. We have to make some conservative assumptions for the ATO.
Yeah, look, if that happened, first of all, I'd have a little cry because it's like, that's a nightmare.
But
like
Rowan, because of that, one of my points was there could be a few $1,000s worth of accounting time and fees.
Exactly. But given the value of the shares and the capital gain that's likely to happen, it's really important to make sure that we get the cost base. So even if you were able to provide the initial number of shares purchased and the date the shares were purchased, that is a really good start because then we can work out what the dividend reinvestment was each time. And work out a very long spreadsheet to be able to update that. Gets a bit more complicated when you are buying and selling throughout the time. But, at least if you have that initial purchase, that's a really good start.
I'm just, for fun, I just brought up ChatGPT, see what they say, right?
Yes.
I
That
purchased
good old ChatGPT.
That's always wrong. Here's this. How's this, rather? ChatGPT is good, but if you don't know what you're freaking talking about to start with, there's so many mistakes in it. So don't rely on it, people, for stuff. Let it do some heavy lifting, but
But then you need to do your research.
Well, you got to know what you're freaking on about.
Exactly.
I purchased $10,000 CBA shares in Australia in 2000, just sold them. There was DRP along the way. What is the value today if sold, and what is the cost base for because it's after pre-CGT flag anyway, so there's a real one in the boat. What is the cost base for the parcel assuming DRP? We might break the internet now. Let's have a look. And that speaks to why going forward, like I don't use a direct CHESS-sponsored broker. I use a platform because I just want all the records to be rock solid. All right, here we go. G'day, Glenn. You've done well holding onto those CBA shares since 2000, especially with the dividend reinvestment plan. And if you are watching on YouTube, I will share this because we are doing more of a show now for YouTube. And thanks for listening, obviously, if you're on Spotify or Apple. So I've shared ChatGPT. Initial investment, $10,000. CBA share price in 2000, approximately $25 per share. Initial shares purchased, $10,000 by $25 equals 400 shares. Auto switch. Participating in the DRP means that instead of receiving cash dividends, you received additional CBA shares. Over 25 years, this compounding effect can significantly increase your total shareholding. Thank you, Captain Science. While exact figures depend on dividend amounts and share prices at each reinvestment point, historical data suggests that a long-term DRP participants could see their shareholding increase by approximately 2.5 times over 25 years. Estimated total shares in 2025, 400 initial shares times 2.5 is 1,000 shares. Bit of a summary here. CBA share price in May, approximately 175. We're at all-time highs. Total value, 1,000 shares times 175 is $175,000. Calculating the cost base for this CGT, initial purchase cost, $10,000. Cost of DRP shares, it's considered a separate purchase. So the cost base for these shares is at their market value at the time of each dividend reinvestment. Yep, we know that.
Yep.
Accurately calculating the total cost base requires detailed records of each dividend reinvestment.
Did we just say that?
Yep. Including dates and the share price. You've kept these records. You can sum the market values. If you've kept these records, you can sum the market values of shares acquired through DRP to determine or to estimate. Okay. Estimating the capital gain. Total proceeds from sale, $175,000. Let's assume that approximately $40,000, including initial investment and DRP shares. So capital gain equals $175,000 less $40,000 equals $135,000. Note, this is a simplified estimate for precise calculation, especially for tax purposes. Consult with a tax professional or financial advisor. Key takeaways, investment growth, your $10,000 potentially grew to $175,000 over 25 years. All that to say, it was useless.
Keep good records.
ChatGPT was basically useless.
Yep.
Now, I don't know, that was just fun. Whatever. Sue me. Don't know where we got there, but anyway, any advice? Yeah. You're going to have to pay an accountant to sit down and do some detailed year-on-year assumptions. They may go back. Look, there is a detailed search function on ChatGPT. It might take an hour to search, but I think it's a manual thing.
The message is, though, that it is going to be quite detailed. It's going to take a long time. It's going to cost you a bit if you don't have these records because it is a long process.
150%. Rach Kroon from This Is Property. How's that going over there, that podcast, now that
it's great.
You've slipped in there with Johnny?
It's been really good. It's been a good few months now.
Yeah, I like it. It's good. And we've got that. That's on YouTube as well, everyone, as well as this podcast and all that. So we've pretty much moved to be a video show, and we do hope that those who listen to our content audibly, that you don't really notice the difference. But for those, we just want to build another audience on YouTube. So there you have it. What's Nathan have to say?
Now, Nathan says, hey all, just after some opinions on what we should do moving forward. I'm a 32-year-old male. We've also got a 31-year-old female and a toddler. Our place is worth around $800,000 with a $400,000 mortgage, and we've got $52,000 in offset. So male earns $1,400 per week net and has $90,000 in super. As of next week, is salary sacrificing $200 per week. 31 female earns $850 per week net and has $60,000 in super. And as of next week, is salary sacrificing $50 per week. We also have around $5,000 in VGS currently. We have around $500 a week spare. Do you think we should continue to build the offset or start to load up on some more VGS? Glenn. That's a lot.
Rach, I'm just having a look here. While you were chatting, I grabbed my pen and paper. So this is an ultimate financial planning 101 discussion. And we always have to It's funny that the producers picked this question because it is similar to the first question. Spoiler, I am the producer. Look, what is your goals? Everything we do in financial advice land on this podcast will go back to what is your goals for your lifestyle and finances. There are other money podcasts, there are other investing podcasts, there's other entrepreneurial podcasts, and the whole aim is to build wealth and print as much money as possible. I'm not cut from that cloth. I'm from the cloth of what do you want to achieve? Let's work back from that and try and achieve that. So I would first say they've got a toddler. My first question, are you planning on popping out any more spawn? Because if you are, okay, well, maybe we just need to build a bit more cash buffer and just, chill out a little bit. Sure, you've got your little salary sacrifice there. Love that. So that's what I would do. The male earns female $850.
And those figures are net.
They're net. So can you maybe see what the total 850 times 52, that's 44. So maybe on 60 for the female.
He'd be on just over 100.
He would, yeah, okay. Good financial position. You got a relatively small mortgage and some cash savings. So congratulations on that. Next week, salary sacrificing 50K, 200 per. Okay. So the male is going to be salary sacrificing 200 per week. Awesome. I'll probably, my first comment is there a discussion in the house where we need to look at having some parity with the super funds? Now, depending on tax rates, it wouldn't necessarily be salary sacrificing more for the lower income earner. It might be better to do some super splitting of the amounts that are going to hubby's, male super. So that's just a little sidebar. Do we want to focus on getting the supers a little bit more even? We also have 5K in VGS currently, which is the Vanguard Global Share ETF. And then we have around 500 a week spare. Do you think we should continue to build the offset? Okay, I'm building up the offset. Number one, I want to know that 50K, what is that? Is it savings for a holiday? Is it a $50,000 emergency fund? Is it saving because we're going to have another child and someone's taking 6 months off work or a year off work? I want to know if you have your full emergency fund and a cash buffer there if there is more children on the way. Honestly, that's my reason for living with that $500 a week spare. Sure, keep the $250 a week overall salary sacrificing to super in the background, knock yourself out, but what is this cash for? So that's what I want to know, number one. Number two, what do you want to do? Is it a goal to aggressively pay off the mortgage? And if that's the goal, well, and this is where you get into this world of paying off the mortgage versus investing in shares or property versus salary sacrifice to super, then investing in shares within super. Whatever way you cut it, whatever numbers that you look at, on paper, the best overall strategy in terms of wealth creation and wealth building and tax minimization is the salary sacrifice capping out super each year, without a doubt. Then we need to say, well, okay, on paper that's better financially. Well, if the goal is to pay down the mortgage, well, we don't want the money in super. The next thing is paying off the mortgage versus investing. Again, categorically, we know over the long term, the investment return, maybe with some franking credits, will be a higher percentage than an interest rate. So could be tracking 8-9%. At current interest rates, you get a mortgage, what, 6, late 5s at the moment?
Yeah, we're in the 5s now.
Awesome. Tim, if you're listening, call me. Hook me up. So we know that investing will give you a higher return, but then enters the chat volatility, risk profile, are the goals there? So these are just questions, and I don't know if I've got an answer. What would you do if they had $500 left over? Because they could, there's a little bit of meat in there. They could buy an investment property if they want to invest.
But I did note that they didn't ask that as one of the scenarios. So I would say that property may not be their preference. It looks like their preference is either to pay off that mortgage or to have more VGS.
Yeah.
What would you do?
Well, I would probably, if it was me personally, I would do exactly what I've said. Make sure that the cash does reflect the real world. Emergency fund, if we need a cash thingy for some parental leave, then I would look at capping out super first. Now, if they are a bit gun shy, I was like, oh, we're 30s, we don't want to put money away for another 30 years. Well, sure, let's invest more outside of super in our own name. My only concern is VGS. I'll just read this, everyone, which is the Vanguard MSCI International Share Fund. I'm pretty sure it's ex-Australia. Yeah. They invest in around 1,300 companies from developed countries, excluding Australia. I would probably want a bit more of a balanced portfolio than just 100% VGS. So that's a discussion there as well. Look, if in doubt, you can always do a bit of both. That's also okay. You can, okay, well, we've got $500 a week spare after we do the Sal Sac. Or is that, as of next week, salary sacrificing. So maybe without the salary sacrifice, there's $750 a week spare.
Yeah.
So we're really, gosh, can I have some tips on how you guys don't spend all your money with a toddler? Yeah, there is actually no answer to this other than if you wanted to, you could, of that $500 a week spare, put $250 into a portfolio in your own name, noting that I think you probably need to look at a more balanced portfolio in terms of diversified, or at least have some Australian equity exposure in there and property and all that stuff. Or pump the mortgage with half of it. What do you want to do? Whoever wrote, Nathan, what's your wife want to do? Ask her. Do that. Because we need to be both on the same page. But yeah, it's a good one. We do have so many listeners who are in their 30s crushing it with good
And they
incomes.
are crushing it.
Oh, amazing. To have, and that's it. Like, I'm also doing some super splitting and getting her super up a little bit, I think.
You've been talking about that a bit lately. I think it's great, the super
It's the
splitting.
best unkept secret or whatever they call it, best kept secret or something like that in relation to super. And we'll put a link in the show notes or a little thing up on YouTube because we did a dedicated YouTube clip on super splitting. It's amazing.
Yeah.
All right. Sorry we can't really help, Nathan, but I just want to say you're crushing it.
Definitely crushing it.
And go and spend some money with an advisor. It's okay to do.
Don't rule out an investment property.
Oh, yeah, all that. That will almost pay for itself.
Oh, depending on what the property is. I just like it to be in the mix.
Yeah. Yep. Hey, it's Glenn here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.